A financial bubble begins not with mathematics or markets, but with human psychology. Driven by a fundamental contradiction, the belief that prices can rise forever, even when the underlying asset has limited intrinsic value, and this contradiction is rooted in deep cognitive biases hardwired into human nature, such as herd behavior, emotional contagion, overconfidence, and the fear of missing out, which collectively turn rational investors into irrational participants once a trend gains momentum. Long before modern economics existed, people experienced phenomena now known as bubbles. And nowhere is this clearer than in the 17th century during Tulip Mania in the Dutch Republic, where single tulip bulbs, ordinary flowers, became symbols of speculative fever, sold for prices more than 10 times the annual income of a skilled craftsman. Not because tulips suddenly produced wealth or dividends, but because sellers believed that someone else would pay more tomorrow, a mindset rooted in human tendency to project short-term gains indefinitely despite long-term fundamentals. And this is the core psychological engine of all bubbles. Similarly, in the early 18th century, FOMO bubble in England revealed how group psychology drives markets. Convinced investors that its debt-for-equity swap and trade monopoly with South America would generate enormous profits, a story that played more like myth than economics, and as enthusiasm spread. Stock prices surged from around £100 to over £1,000 per share. Not because earnings justified this rise, but because investors collectively bought the story, anchoring future expectations unrealistically to current price momentum. The psychology at play in these early bubbles demonstrates how humans rely on social proof, the belief that if many others are buying, it must be valuable, and when individuals see rising prices, they update their beliefs not based on fundamentals, but on the behavior of others, turning markets into emotional amplifiers, where hope, greed, and fear feed on each other. Cognitive biases like overconfidence lead investors to believe they possess special insight, while anchoring causes them to fixate on recent high prices as a new reference point, reinforcing the belief that prices will continue upward, while narrative causation, the human preference for storytelling, turns complex market dynamics into simple tales of triumph that are easy to share and hard to question, psychologically binding the group to a collective illusion. In both Tulip Mania and the South Sea Bubble, early participants who recognized the psychological distortion and sold early profited, while latecomers, overwhelmed by fear of missing out, entered at peak valuations only to suffer catastrophic losses when reality reasserted itself and prices collapsed, underscoring that bubbles are not just financial phenomena, but psychological events where waves of human emotion shape markets more than earnings, dividends, supply, or demand. Throughout history, as societies become more interconnected and information spreads faster, the psychological drivers of bubbles, imitation, exaggerated expectations, and emotional contagion become more powerful, going the earliest recorded episodes and carrying timeless lessons about how human cognition can turn ordinary markets into extraordinary illusions of wealth and risk. Once a financial bubble begins, it survives and expands not because of rational valuation, but because of mass psychology amplified by communication systems, social reinforcement, and feedback loops that cause belief to harden into certainty. As individuals stop asking whether an asset is worth its price and instead focus on whether others will continue buying it, creating a self-reinforcing cycle where rising prices become proof of correctness rather than warning signs, a psychological shift that has repeated across centuries with remarkable consistency, from early print media to modern social networks. During the 19th century railway boom in Britain, newspapers played a central role in legitimizing speculation by portraying railway stocks as symbols of national progress and technological destiny, encouraging middle-class investors to participate, not merely for profit but for identity, as owning shares became psychologically associated with intelligence, patriotism, and modernity, demonstrating how social narratives transform speculative behavior into moral or cultural validation. This pattern intensified in the 1920s United States, when mass media, radio broadcasts, and newspapers relentlessly celebrated stock market success stories. reinforcing optimism and minimizing risk, while brokers extended easy credit through margin trading, allowing ordinary citizens to leverage small amounts of capital into large market positions, which psychologically detached investors from downside risk, since losses felt abstract until prices fell sharply. At the core of this behavior is confirmation bias, where people seek information that supports their beliefs and dismiss warnings as ignorance or jealousy. Combined with availability bias, where recent success stories dominate perception and make catastrophic outcomes seem impossible, leading investors to believe that this time is different, a phrase repeatedly documented before every major crash. As bubbles grow, dissent becomes socially costly. Skeptics are marginalized, and caution is interpreted as incompetence or fear. While group enthusiasm evolves into collective conviction, a phenomenon studied extensively in behavioral finance. In crowd psychology, where emotional contagion spreads optimism faster than facts can counter it, the media does not create bubbles alone, but it accelerates them by compressing complex realities into simple narratives of endless growth, while price charts themselves become psychological weapons, visually reinforcing momentum and convincing participants that risk has disappeared. When warning signs finally emerge, rising debt, overvaluation, slowing earnings, the same psychological forces reverse direction, transforming greed into panic almost instantly, because belief once broken collapses faster than it formed, revealing that bubbles persist not due to ignorance, but because humans are wired to trust collective belief over individual doubt, especially when surrounded by social proof, technological change, and stories of effortless wealth. At the deepest level, financial bubbles are powered not by markets but by the human brain, because speculative environments activate the same neurological reward systems involved in gambling, addiction, and risk-seeking behavior, causing rational AOGS evaluation to be overridden by emotional reinforcement, a process that modern neuroscience has helped explain, but that investors continue to underestimate. When asset prices rise rapidly, the brain releases dopamine, a neurotransmitter associated with reward anticipation rather than reward itself, meaning investors become addicted not to profit, but to the expectation of profit, which creates a feedback loop where each gain intensifies confidence and suppresses fear, reducing sensitivity to risk signals such as volatility, leverage, or valuation metrics. This neurological response explains why individuals in bubbles exhibit overconfidence bias, consistently overestimating their ability to time exits or identify superior assets, believing losses happen to others, not themselves, a phenomenon extensively documented during the dot-com bubble of the late 1990s, when investors poured capital into unprofitable technology companies purely on the promise of future growth, ignoring fundamentals like revenue, earnings, or cash flow because rising stock prices themselves triggered reward responses that substituted for rational analysis. Brain imaging studies conducted after the 2008 financial crisis revealed that during speculative manias, the brain's prefrontal cortex responsible for judgment and long-term planning becomes less active, while emotional centers dominate decision-making, explaining why highly educated professionals behave no differently than amateurs once embedded in euphoric markets. During the U.S. housing bubble, its neurological distortion was amplified by leverage and social validation, as rising home prices produced repeated dopamine reinforcement cycles for homeowners, lenders, and investors, leading to the belief that housing was safe, psychological reclassification that suppressed fear and encouraged excessive borrowing, securitization, and risk stacking throughout the financial system. As gains accumulate, investors experience risk blindness, a condition where warning signs are cognitively processed but emotionally discounted, because acknowledging danger would disrupt the reward cycle, making denial psychologically easier than reassessment, which explains why many investors intellectually recognize bubbles while emotionally participating in them. When prices finally stall or fall, dopamine levels crash, triggering panic, loss aversion, and aggressive selling. It's often far more violent than the initial rise, as the same neural systems that fueled greed now amplify fear, demonstrating that bubbles are not simply collective mistakes but predictable neurological events where human biology collides with financial systems capable of magnifying emotional extremes at global scale. Financial bubbles are not sustained by individual psychology alone, but are amplified and legitimized by institutions whose incentives, beliefs, and cognitive biases align with rising markets, creating a dangerous illusion that systemic risk has been eliminated, because banks, regulators, governments, and even academic experts are subject to the same psychological forces as individual investors, yet possess far greater power to shape outcomes, as seen repeatedly throughout modern financial history. During prolonged expansions, institutions experience collective overconfidence, where past success is mistaken for skill rather than favorable conditions, leading decision-makers to believe they have mastered risk management, a mindset that was clearly visible before the 2008 global financial crisis. When major banks assumed that complex financial models, diversification, and securitization had permanently reduced the danger of large-scale collapse, despite mounting evidence of excessive leverage and deteriorating loan quality. This institutional overconfidence is reinforced by incentive structures that reward short-term gains and punish caution, as executives, traders, and politicians benefit immediately from rising asset prices through bonuses, tax revenue, and electoral support, while the costs of collapse are delayed and often externalized onto the public. It's creating a psychological environment where ignoring risk feels rational and opposing the bubble feels professionally dangerous. Regulators are not immune to this mindset, as they often suffer from normalcy bias, the belief that because catastrophic events have not happened recently, they are unlikely to happen at all, leading to regulatory complacency and the acceptance of industry narratives that innovation has made old rules obsolete, a phenomenon evident in the deregulation of financial markets in the late 20th century. Warning voices were dismissed as outdated or pessimistic. Academic economists and rating agencies also play a critical role by providing intellectual justification for bubbles, often relying on elegant mathematical models that assume rational actors and efficient markets, which psychologically reassure policymakers and investors that extreme outcomes are improbable, even as real-world behavior deviates sharply from these assumptions. As bubbles grow, institutional consensus hardens. Dissenters are marginalized, and systemic risk becomes invisible precisely because it is everywhere, embedded across balance sheets, regulations, and political narratives. And when collapse finally occurs, institutions shift rapidly from denial to emergency response, revealing that the true psychological failure was not ignorance, but the belief that authority, expertise, and technology had conquered uncertainty, when in reality, they had merely disguised it. Every financial bubble ends the same way it begins, inside the human mind, because bubbles are not historical accidents or policy failures alone, but inevitable outcomes of psychological patterns that emerge whenever humans interact with opportunity, uncertainty, and social reinforcement at scale, meaning that no amount of education, regulation, or technological advancement has ever eliminated them, only changed their form, speed, and reach. Bubbles end when belief can no longer sustain itself, often triggered by a small disruption, such as slowing growth, rising interest rates, or a single high-profile failure that breaks the narrative spell. It's causing collective confidence to fracture, and revealing how fragile prices were once detached from fundamentals, as seen in the collapse of the dot-com bubble in 2000, when a handful of earnings disappointments exposed that many internet companies would never generate profits. Or in 2008, when falling home prices undermined the assumption that housing could only rise, instantly reversing years of psychological conditioning. When this shift occurs, loss aversion, the brain's tendency to feel losses more intensely than gains, takes control, transforming optimism into fear far more rapidly than logic would predict, leading investors to sell not because valuations are low, but because they are desperate to avoid further pain, which creates cascading feedback loops in reverse, where falling prices validate panic, just as rising prices once validated greed. What makes bubbles especially dangerous is that participants rarely perceive themselves as irrational while inside them, because the psychological environment rewards conformity and punishes skepticism, meaning awareness of past bubbles does not protect against future ones, a reality proven by repeated manias in technology stocks, housing markets, cryptocurrencies, and speculative assets across generations. As markets recover, memory fades, emotional scars heal, and a new narrative emerges claiming that lessons have been learned. Yet the underlying cognitive biases, overconfidence, herd behavior, narrative fallacy, and dopamine-driven reward seeking remain unchanged, waiting only for a new catalyst, whether technological innovation, financial engineering, or geopolitical shifts to restart the cycle. The final truth of financial bubbles is uncomfortable, but essential. They are not bugs in the system, but features of human psychology interacting with markets. And while individuals and institutions can reduce exposure through discipline, skepticism, and structural safeguards, bubbles themselves cannot be eliminated without eliminating human emotion, ensuring that the psychology of bubbles will continue shaping booms and busts as long as people believe that this time is different.